Hello viewers, welcome to my channel. I'm Hasham. This is the second video on the subject income tax for the assessment year 21-22. The last video I have explained the meaning of the term tax, characteristics of tax and objectives of taxes. Then different types of taxes, classification of tax, then canons of taxation, tax structure. All these things I have explained you in detail in the last video. So if you have not watched that, first of all, go to the playlist of my channel. Select the subject income tax for the assessment year 21-22. Watch the first video, because without understanding the meaning of tax, you should not proceed ahead. You should be clear regarding the meaning, characteristics, types of taxes. Now in this video, I am going to explain you the topic about the basic concepts which are used in income tax. And these concepts are frequently asked in examination also. Without understanding the concepts, it will be highly difficult for you if this concept comes in the problems. So watch the video till the end. Don't skip in between. First of all, basic concepts of income tax. The levy of income tax in India is regulated by Income Tax Act 1961. All the provisions are contained under Income Tax Act 1961. So some of the important terms which are used in the act, which have been defined under section 2 of the Income Tax Act, are given below. So section 2 of the Income Tax Act 1961 has given the meaning of different terms which are frequently used in the income tax. So every student must be clear regarding the meaning of different terms. First term is SSC. SSC means any person from whom any tax or any other sum of money is due to the department, whether on his own income or on the income of any other person for which he is liable, or a person against whom income tax proceedings has been started by the act, or an SSC in default. So again I explain the meaning. SSC means any person from whom any tax or any other sum of money like interest or penalty is due to the income tax department, whether on his own income or on the income of any other person for which he is liable, or SSC may be in default, or a person against whom any proceedings under the income tax has been started. That person is called SSC. If we elaborate this definition, we can say a person whose income during the current previous year exceeds the basic exemption limit. For the current assessment year 21-22, the basic exemption limit is 2,50,000 rupees for non-senior citizen. Senior citizen 3 lakh and super senior citizen 5 lakh. So if a person's income exceeds this basic exemption limit, he is liable to pay tax. He is called an SSC. Similarly, if a person is not liable to tax but is liable for interest or penalty, the person will be called as an SSC. Similarly, a person whose income exceeds the basic exemption limit but he has not filed the return, he has not paid the tax, the Income Tax Act will start the proceedings against that person. Then the person will be called an SSC. Similarly, normally a person is liable to pay tax on his own income, but sometimes a person is liable to pay tax not on his own income but on the income of any other person. Like for example, a minor is there. A minor is having an income. A minor cannot file the return. A minor cannot pay the tax. So there should be some guardian. The guardian is called the deemed SSC. Similarly, a person is lunatic, unsound mind, then a person should be responsible for paying the tax on that person, on person's income. He is called a deemed SSC. Similarly, an SSC in default, when a company has deducted TDS from the employee's salaries, it is the responsibility of the company to deposit that TDS to the income tax department. Suppose if the company failed to deposit the TDS, he is called SSC in default. So these are the different situations where a person will be called an SSC. First one over. Second, person. Normal language, a person means a natural person. But from income tax point of view, a person includes a natural person and also a Hindu undivided family. We are all natural persons. Whatever income we earned, we are liable to pay tax because we are a person, natural person. Similarly, a Hindu undivided family is also a person. A Hindu undivided family is a group of persons who are lineally descendant from a common ancestor. The head of the family is called Karta, and Karta is liable to pay tax on the income of the HUF. So individual is a person, HUF is a person. Similarly, a company which is incorporated under the Companies Act 2013. A company is also a person. So a company earning the income has to pay the tax. The company has to pay the tax. It's a person. Similarly, firm, a partnership firm, a group of partners running a partnership business. So partnership firm is also a person. Apart from that, artificial association of persons, an association of persons or body of individuals like a joint venture. A group of persons have started a business of joint venture. It is an association of persons. That is also a person. Similarly, every artificial juridical person, that means any person, association which is not there in the first four categories will be put to tax as a person under every artificial juridical person. So in examination they may ask you who is a person under the income tax. Just now I have explained all these points, you have to write. Previous year. Previous year means a period of 12 months beginning from 1st April every year and ending on 31st March next year. The income earned during the previous year is taxable in the assessment year. Example, our current assessment year is 21-22. 21-22, it started from 1st April 21 and ended on 31st March 22. For this assessment year, the previous year is 2021. 1st April 2020 to 31st March 2021. So 1st April, see here, previous year is 2020-21 and assessment year is 2021-22. Our current assessment year is this one, 21-22. For this, the previous year is 2021. So income, whatever income earned during this previous year, that will be taxable during the assessment year. So remember, current previous year started on 1st April 2020 and current previous year ended on 31st March 2021. This period is called previous year. Next comes assessment year. Assessment year means the period of 12 months beginning from 1st April every year and ending on 31st March next year. Example, our current assessment year is 21-22. So it started from 1st April 2021 to 31st March 2022. This is called assessment year or tax year. In this assessment year, the income of the SSC will be computed which he has earned during previous year. So income earned during previous year is taxable in the assessment year. This is called assessment year. Next comes income. See here, income tax is a tax on income. But unfortunately, Income Tax Act has not specifically given the meaning of the term income. It has given the characteristic features of income. So it has given that these receipts are called income. So we can say every receipt is not income. Only whichever is the receipt which is declared by income tax as an income, that is an income. Example, a person has taken a loan of 10,000. That is a receipt, but that is not an income. So every receipt is not an income, but every income is a receipt. We can say like this. So Income Tax Act has given an inclusive definition of the term income. It has not given exclusive definition. Inclusive. Income includes the following: profits and gains of business, dividend income, interest received, salary received, income from property received, so capital gain on transfer of capital asset, winning from lottery, crossword puzzles, games, betting, etc. Apart from that, forfeited amount in case of capital gain. So many examples have been given by Income Tax Act that these are called incomes. Then how to specifically we can say it is income? We depend on the judgment given by High Court and Supreme Court in India regarding the meaning of the term income in different cases. A number of cases were put before the High Court and Supreme Court to decide whether it is an income or not. So High Court and Supreme Court has elaborated, studied and given the conclusion that this is income and this is not income. So what are the characteristic feature? First of all, income should be in cash. If a person has earned the income in kind, then by applying the provisions of income tax, we have to convert it into cash. Secondly, income should be from a definite source. Income Tax Act has given the sources. A person may get the income from salary, income from house property, income from business, income from profits and gains and capital gain, other sources, different sources. Second, income should be legal or illegal. Income tax is not bothered whether you have earned legal income or illegal income. If you have the income, you have to pay the tax. That's it. Other laws are there which will take care of whether it is legal or illegal. But income tax not bothered. Every income is taxable. Similarly, income should be generated from outside. A person should not earn income from himself. Example, the pocket money received by the children or the pin money given by the husband to wife. That is the income within the family. It is not an income. It is not taxable. Right? So these are some of the characteristic features of the incomes which are given by the High Court and Supreme Court in India. In the light of those characteristics, we can decide whether income is taxable or not. Whether it is an income or not. Next comes gross total income. Gross total income is the aggregate of incomes under the different heads. Income Tax Act 1961 has given 5 heads of income. Income from salary, income from house property, profits and gains of business and profession, capital gain and other sources. So the total of these 5 heads of income is called gross total income, GTI. Total income. From gross total income, deductions are given under section 80. These deductions are from 80C to 80U. So many deductions. But only if a person is eligible, they will get the deduction. Every SSC will not get the deduction. Example, deduction under section 80C, qualified saving. A person has deposited some provident fund, life insurance premium, etc. He will get deduction under section 80C, qualified saving. Deduction under section 80D for medical insurance premium. If an SSC has paid medical insurance premium, he is eligible for deduction under section 80D. Similarly, 80G. If a person has given donations, conditions are given. So if donations are given, complying the conditions, then deduction under section 80G will be allowed. So many deductions. If deductions are deducted, then the resulting figure is called total income. Simply you remember, gross total income minus all deductions under section 80 will get the total income. Then taxable income. From total income, deduct the basic exemption limit. The basic exemption limit is 2,50,000 for non-senior citizen, Who is a non-senior citizen? A person who is below the age of 60 years. Below the age of 60 years, 2,50,000. Over 60 years up to 80 years, senior citizen. Over 80 years, super senior citizen. So basic exemption limit is 2,50,000, 3 lakh and 5 lakh. So from total income, if we deduct the basic exemption, then we'll get taxable income. Then return of income. Every person who has to give the details, a form is given by the income tax department regarding the submission of details of the incomes, expenses, savings of a person. A person who is having so many incomes, he has to submit all the details of his income to the income tax department through a form. That form is called return of income. In that form called return of income, the assessee has to submit the details, how much income he earned, how much expenses he incurred, how much are the savings. All the details he has to submit to the tax department in the form of return. And the process of submitting the return is called filing the return. Nowadays, filing the return is online. Online, the assessees are filing the returns. The next one is permanent account number. Every assessee will be allotted a permanent account number by the assessing officer for easy identification. There are many cases where names are same for different people. It will be a problem for the income tax department to identify the taxpayer. So every taxpayer will be given a unique identity number. That identity number is called permanent account number. So a person has to apply to the assessing officer to be allotted a permanent account number. So whenever he is filing the return, whenever he is communicating with the income tax department, he has to specify his PAN, permanent account number. So accordingly, the assessing officer will recognize that person through PAN number, not through name. The PAN is very, very important. So one person will be allotted only one permanent account number. And it is not necessary that every year PAN should be allotted. If a person applied only once, it will be applicable every year. Not needed every year should be applied. If a person has lost his permanent account number, he can apply for a new permanent account by paying nominal fee. Income Tax Act has given some specific rules regarding permanent account number, when permanent account number is compulsorily needed. Compulsorily needed. When a person's income exceeds the basic exemption limit, when a business is having income, when a business is having receipts or sale more than 5 lakh, compulsory they have to submit, apply for permanent account number. So many specific reasons are given. Reasons are given for compulsorily having the permanent account number. So if a person has applied for 2 permanent account numbers, he has to submit 1 permanent account number back to the department. Otherwise, he will be punishable by law. So this is permanent account number. Now, average rate of tax. See here, normally average rate of tax we require for advance payment of tax. So how to compute average rate of tax? We calculate how much was the tax liability last year and how much was the taxable income last year, total income last year. So how much was the total income and how much was the tax liability? Example, a person's tax liability was 2 lakh rupees last year. The total income was 10 lakh. The person has earned a total income of 10 lakh and his tax liability last year was 2 lakh. So we have to calculate the average rate of tax. So 2 lakh rupees is the tax and 10 lakh rupees is the income. So total tax divided by total income into 100. 20% is the average rate of tax. Next, deemed income. Normally, a person is liable to pay tax on his income. Whenever a person's income exceeds the basic exemption limit, compulsorily he has to pay the tax. But sometimes cases will arise where a person has not paid the tax. That means his income is above basic exemption limit. He has not disclosed his income. Later on, when the income tax department come to know that this person is having the income and he has not paid the tax, undisclosed income, that will be termed as deemed income. Income tax department has the right, the assessing officer has the right to ask explanation from the assessee regarding the incomes. If an assessee fails to give satisfactory explanation about his income to the department, then income tax department will treat as it is your deemed income. Example, in your books, you are found to have a cash credit, of rupees 10 lakh. Income tax department has the right to ask you, from where did you get this 10 lakh rupees? Show us, give the explanation, give the proof, from where did you get this? If the assessee fails to give satisfactory explanation, then income tax department will treat that as a deemed income. On this deemed income, the tax rate is 60% for the current assessment year 21-22. For deemed income, undisclosed income, unexplained income, income tax rate is 60% plus surcharge plus health and education cess without giving any basic exemption. So what are the examples of deemed incomes? First one, cash credit. Suppose in the books of accounts of the SSC, some cash credit is found and the SSC fails to give satisfactory explanation. That cash credit will be termed as deemed income, on which 60% tax plus surcharge plus education cess, no basic exemption. Secondly, unexplained investment. If the assessing officer find some investment in the books of account of the SSC, but SSC fails to give the explanation about this investment, from where did you get the money to buy this investment? If the SSC fails, income tax department will treat it as a deemed income. He has to pay the tax. Next one, unexplained money. If a person is having huge money, for example, a person is walking on the road, suppose in his car, he is carrying some 10 lakh rupees cash. Suddenly, all of a sudden, there was frisking and the person found with 5 lakh rupees, income tax department will come and ask, from where did you get this 5 lakh rupees? What are the sources? Tell us the sources. If you give the right answer, nothing will happen. If you give unsatisfactory explanation of holding this cash, we'll treat it as a deemed income. You have to pay 60% tax. Then amount of investment not fully disclosed. Investments are there, but not full disclosure of investment. Example, a person has made investment of rupees 50 lakh, but in the books of account he is showing investment of only 10 lakh. Only 10 lakh investment showing, really investment 50 lakh. Income Tax Act says the remaining 40 lakh will be treated as a deemed income, on which 60% is the tax. Unexplained expenditure. Income Tax Act says if a person escaped by not showing the income, he will be caught in expenditure. Example, a person is not paying the tax. He is telling to the income tax department, my income is below the basic exemption limit. I am not liable to pay the tax. Later on, he went to buy a car. The value of the car is 60 lakh. He is buying a car for 60 lakh. Then income tax department will give a notice to that person. Are you paying the tax? The person says, no, my income is below basic exemption limit. I am not paying the tax. Then from where did you get the 60 lakh rupees to buy the car? The person is caught in the expenditure. The income tax department will ask for explanation. If the SSC fails to give explanation, income tax department says this 60 lakh rupees worth of car which you are purchasing is your deemed income. You have to pay the tax 60%. Similar, if a person goes to buy the gold, he has bought 50 lakh rupees worth of gold ornaments. He is not paying the tax. Income tax department will give the notice. What are the sources? From where did you get this money to buy this 50 lakh rupees worth of gold? If unsatisfactory explanation, then tax will be applied. This is called unexplained expenditure. Next, amount borrowed paid on hundi. In vernacular language, hundi means transfer of funds from one person to another person without any record. Without any proper record, the money is transferring from one hand to another hand. That is called hundi. So if a transaction is found, whether payment on hundi or receiving on hundi, it will be treated as his income, deemed income. He has to pay the tax. So in examination, you will be asked, what are deemed income? What is the tax rate? Give examples of deemed income. So I've explained this. Last one is exceptions to general rule. The general rule is income earned during the previous year is taxable in the assessment year. Whatever income a person earns during the previous year, it will be taxable in the assessment year. That is a general rule. For everybody, this rule will apply. But there are certain exceptions where a person is taxed not in the assessment year, but in the previous year itself. Same year, in the previous year he is earning the income, and in the same previous year he has to pay the tax. This is called exceptions to the general rule. So under what circumstances a person is liable to pay tax in the previous year itself? He should not wait till assessment year. So what are the exceptions? The first is person leaving India with an intention not to return to India during the assessment year, relevant assessment year. If Income Tax Act found a person who is leaving India for a job, so a person who is going for job outside will not immediately come. He will come over a period of time, after passing a period, after a period of time. Income Tax Department says, if a person is leaving India with an intention not to return back during assessment year, he has to pay the tax during the previous year itself. Example, our previous year is 2021, assessment year 21-22. Income earned during previous year is taxable in assessment year. That is a general rule. But if a person is going abroad for job during 2021, his intention not to return back in the assessment year, only after 2-3 years he will come back. Income Tax Act says you are going for job. Whatever income you have earned during previous year, pay the tax before leaving the country. Before departure, you have to clear the tax slab. Secondly, income of non-resident shipping companies. There are many shipping companies which runs ship from one country to another country. So if a shipping company is having a office in another country, no need to pay. Example, a shipping company, XYZ company, is incorporated in London. They are having the corporate office at London. They don't have any office in India. So every time ships are coming from London to, suppose, India, then whatever income this shipping company is earning from Indian soil, that means they are carrying the goods and passengers from India. So whatever income earned by XYZ company from India, they have to pay the tax in India and then only leave the port. Without paying the tax, it should not leave the port. It should not say, I will pay the tax in assessment year. You have to pay the tax in previous year itself. If the shipping company is having a registered office in India also, then the ship can go, because Income Tax Department will collect the tax from their office, registered office in India. The next one, income of discontinued business. If a business is discontinued during the previous year, then as soon as the business is discontinued, they have to pay the tax in the previous year itself, should not wait till the assessment year. Then person transferring the assets to avoid the tax. If the Income Tax Department finds a person who is transferring the assets in order to avoid the tax, so in that case, Income Tax Department says, whatever income you have earned during the previous year, pay the tax now itself, because you are transferring the assets in order to avoid the tax. Lastly, incomes of bodies or association formed for short duration. There are some associations or bodies or organizations which are temporary. For a short period of time, some association is formed, earn the income. Immediately they have to pay the tax. Example, a joint venture. ABC3 partners, they have entered into a joint venture to construct a building and sell it off. The building was constructed in a period of 6 months, and after 6 months the venture is closed. The partner business is over. It's a short duration business. So Income Tax Act says whatever income you have earned during the previous year, same year you have to pay the tax. Don't wait till the assessment year. So in this video I have explained you about the basic concept